for joining us for today's market briefing. In today's briefing, we will review the state of the housing market and the key role it plays in the economy. The rapid and robust interest rate moves throughout 2022 put pressure on the housing market after prices reached record highs all across the U.S. However, mortgage rates have recently started gradually declining. This lends to mixed opinions on where the housing market goes from here. U.S. existing home sales fell by 2.5 million over the last 22 months to levels last seen during the Great Financial Crisis. The Fed's efforts to bring inflation back under control have reined in the housing market that started to boom during the pandemic. The cooldown spooked sellers, with many homes being taken off the market, and new listings fell 28% year over year, the largest drop on record apart from April 2020. New home orders fell as mortgage rates found 20-year highs last year, while 30-year fixed-rate mortgages stabilized toward the latter half of 2022. Housing starts decreased by 17% last year. This decline was similar to what was seen during the 2008 global financial crisis. Inventories are still at low levels, though, which marks a key difference between now and the GFC. Supply resting at near historical lows has strengthened demand relative to other downturns, helping to maintain higher home prices. As we progress through 2023, the U.S. economy continues to be influenced by many factors: high inflation, steep interest rates, recession fears, and geopolitical uncertainties, just to name a few. There are indications that a correction in the housing market may be in motion. Mortgage rates are showing signs of ease, but rates are still nearly double what they were a year ago. Following a few years of rapid acceleration, home prices appear to be coming back down, although slowly, which makes it a challenge for many buyers to access housing within their budget given the higher mortgage rates. Investors have welcomed cooler inflation readings over the last few months. However, shelter has been one of the stickier contributors to inflation. In addition to increasing home prices, rents also surged during the pandemic, but rental price appreciation seems to have plateaued, with the most recent readings showing modest 0.1% monthly increases, and rents in some of the country's most populous cities, such as New York and Houston, have been declining for the past few months. On the other hand, rental vacancies are at historical lows, which helps keep rents high and underscores a supply problem for renters. Average rent has an inverse correlation with the overall vacancy rate. But housing starts in the multifamily segment, including apartment buildings and condominiums, have held up thus far. If rental supply increases, it's possible that rents could decline further in the coming months. We're starting to see cracks in the U.S. housing data, which is typically a leading indicator for economic health. The Fed's efforts to bring inflation back under control have reined in the housing market that started to boom during the pandemic. The cooldown may have spooked some sellers. However, housing supply resting at near historic lows has kept demand strong relative to other downturns, supporting higher home prices. This, coupled with high mortgage rates, has made overall housing less affordable. With expectations of further Federal Reserve action on the horizon, housing could be in for a volatile year. Investors will keep a close eye on the housing market throughout 2023 as a leading indicator of economic health. From all of us here at RMB, thanks for tuning in. We hope you're able to join us for our next installment of Market Briefings.